Welcome to Markets Now. I'm Michelle Rook with Roose U.S. Commodities. We saw a lower day in the grains, livestock mostly higher except for the live cattle complex. All right, Don, let's talk about the grains. In sum total, it was kind of a disappointing day. You had pretty decent exports on the weekly basis and all the grains. You've had a couple days of soybean export flash sales, but you can't get the market to move.
Yeah, it's that time of year that, like we say, a bull needs to be fed every day, and sometimes it needs more feed than you think. And, there was just too much with the negative news. The Chinese inking a deal with Brazil, I think, was a psychological negative for the demand side. Dollar making 2-year highs, that was a bit of a negative here. And, we're weather in South America non-threatening. So it's just one of those things. There just wasn't enough news here with the carry out as large as it is, with a large South America crop in the oven to give us much strength technically with the trends down, Michelle.
Yeah, in soybeans, you mentioned down at what, new lows?
Yeah, the soybean market makes new contract lows. Like we say, a bull market doesn't make new contract lows. So I think what we're trying to do is really find a level where we clear supplies from a demand standpoint. And you don't like to look too far ahead, but weather in South America is non-threatening. Early harvest on some of the far north soybeans are going to be the end of December into early January. So that's just a reminder that you've got competitions just ahead of us. And it looks like our demand on export sales should really start to slow down as we move into December. And China, the biggest buyer in the world, concentrates more on South America purchases.
Right. And of course, like you said, South America, no threatening weather. The other problem for the soybean market has been soybean oil. And why has soybean oil been going down so quick?
Well, I think number one, I think technically it just moved up to a level where we got too overbought. Then I think when you look around the world, palm oil has been really the thing that's been pushing us to the upside, and that kind of stalled out. And it looks like China is trying to sell their veg oils into the world. So I think that just told us that they kind of put a cap on some of the bean oil here, and that it really pressed the soybeans down, Michelle.
Specifically on corn, do you think corn just followed soybeans down, or are we gearing up for option expiration tomorrow too?
Well, I think the corn market tried to follow the wheat market up, and then, trying to add some risk premium for some of the Black Sea issues, tensions, if you will, between Russia and Ukraine. And when the wheat market really just kind of stalled out, the corn market just saw some liquidation. Remember, the funds are long on the corn, over 100,000 bushels, 100,000 contracts. So, they're short on the wheat, short on the soybean. So I think it was just one of those that you went up to resistance. You technically stalled out at some areas where we have a hard time getting over, and just a relaxed market with options expiring in a market that really just continues to be range bound. There's not really a catalyst to push us up sharply. At the same time, we're kind of at fair market value, so you can't really go down a lot either. So it's this tight range, if you will, on a lot of these grains.
At the same time, corn basis levels have been very, very strong, positive basis in a lot of areas. So maybe it doesn't matter about what the futures are doing, huh?
Well, I think you're right. I mean, the farmer's really looking at a cash price, and it just really doesn't work for a lot of producers at this level on corn or soybeans or wheat, for that matter of fact. So the producer is a solid holder. The end user, of course, needs supplies. You think about it, we use over 1.2 billion bushels of corn every month. So you need some movement. And the producer, probably we're at a period now with it tucked away from in the bins, that the producer probably time is going to buy grain more than a price if things don't change. So it's just after the first year, I think they probably reassess it again. But for now, basis level strong. Also, the spreads continue to narrow in, Michelle. So crunching in the carries in the market.
Yeah, no doubt. Those forward spreads, certainly a good indication of what you said. Either producers aren't selling or we do have better demand than we thought. Okay, so the wheat market, Don, you mentioned that, we did put some more premium in early in the week. We failed today. Is that just because we've gotten that priced in already, or did we just kind of run up into chart resistance again?
Well, I think first of all, we ran into chart resistance. We couldn't really push over some of these tough technical areas. And I think there's no real respect for that the world is real, or that the war is going to really escalate. I think it's almost the other way. We get a change in the administration, that we're going to have more of a peace agreement, and we're going to get back to maybe not normal, but more of a normal production in the Black Sea area. Has really been disrupted. Of course, we've got a dry drought condition going on in both eastern Ukraine and Russia. Russia, largest wheat exporter and largest producer in the world single-handedly. So we're going to watch that real close. But for now, eyes are on the bigger production in Argentine wheat and also on Australia wheat, and the improved weather that we have here in the wheat area of the U.S., Michelle.
Right. And wheat probably also under pressure with that higher dollar today. You mentioned that earlier. So did we make new highs? Did we have a breakout in the dollar? And if so, what does that mean for the whole ag complex?
Well, I think when you look at the dollar, first of all, that's right. I mean, we're back up, went through 24, went through 23 highs. So, you're back to 22. And I think part of the issue is the dollar's very concentrated on what happens to interest rates. And I think with budget basically out of control, I think the trade is trying to say that, listen, these big slash in interest rates maybe don't occur, or if they do, they're a lot slower. So I think it goes back to interest rates, and that gives some strength to the dollar. And I think the trade's not that confident that interest rates are going to go down a lot, Michelle.
Gotcha. So cattle futures ended mixed. We had feeders higher, live cattle lower. Do you think live cattle just saw some profit taking, or is that caution before the cattle on feed and the cash market development?
Well, the cash cattle market looks like we're going to be maybe steady dollar lower this week. And, I think part of it is, of course, we got Thanksgiving coming up here. The packer killing for a short kill week, this week. And it's really the demand side of the market. The box beef, it runs up to an area of resistance. It seems like 310, 315 really just stalls out when it gets up there. And we get a pullback on the beef that pulls the cattle market back down, pulls the cash down. Packers losing probably somewhere around $50 a head now. So he's not real willing, particularly with the weights, still big weights running 23,000 head over a year ago, more just because of the extra pounds that we're putting on. So long term, of course, the story remains bullish, but the short term is, I'd say, still kind of dicey. And of course, you can always have a black swan someplace. So demand is the issue. Thanksgiving's close, and we'll see once week by week how the demand clearance is, Michelle.
All right. That seasonal weakness is not abnormal. Feeders have been on fire, though. Do they continue to stay strong here just because the cash market is so strong?
Well, I think when you look at the feeder cattle, I mean, I think it's really, you're chasing a supply that just isn't going to be there going forward. The numbers aren't there. And now we've increased the moisture in some of these pasture areas, if you will. And so I think there's a belief that we see that maybe we're going to start heifer retention, a little more of a reason there, maybe hold back, a cow here a little bit longer. So maybe a little bit of expansion starting. So that's tightening up the feeder cattle supply going forward. Just not the numbers going to be there, Michelle. So that's the strength. The bull market in the feeders is the really the strength in the cattle market.
Absolutely. And that's what I'm hearing out in the country, too. All right, the hog market, we managed to shake off the higher dollar, but is that funds defending their longs, or is that just because we have such a big discount to the index?
Well, if you look at it, the hogs, I hear you're sitting with record longs in the futures market. So, that's not a negative. And the discount in the typically is just too big. December versus the index, roughly around $9-10. So that's kind of an anchor for the front months. And then when you look at the back months, you're getting close in those summer months up to around 100. So the question is, with the dollar moving higher, maybe trade issues with big buyer Mexico going forward, how much further can you push up into this resistance of 100? So I think it's a market that, it's a little bit positive here, but, it's got to be very careful with the funds this heavily long, Michelle.
Yeah, no doubt. All right. Thanks so much. Roose U.S. Commodities. That is Markets Now.